the US Federal Reserve is going to announce its next action in a little bit over a week from now. Where do you see the world's inflationary pressure, and where do you see interest rates right now?
Well, it has been already some time since we started to see early this year a very important spike in inflation. This is a global phenomena. For the first time, I would say in modern history, we have a global inflationary phenomena. A lot of it, its origins can be tracked down to the COVID-19, the impact of it, the impact of the policy response, among them the monetary and fiscal stimuli in many advanced economies in the world. And then the inflationary pressures were augmented by the very unfortunate invasion of Russia to the Ukraine. I think that given that this is a global phenomena, pretty much all central banks have been tightening monetary policy. I think a lot of progress has been made. I think it was decided that some amount of anticipatory response or early response was necessary. In many different countries in the world, we're seeing close to a peak in inflation. In the very particular case of the US, it seems that we are there or not very far from there. So I think what can be expected about interest rates is, if we think of three phases in the process of adjusting interest rates. First is the speed of increase, second the terminal rate, third how long will interest rates stay high. We're probably finishing the first stage towards the second stage. So progress has been made, but still we will have to face a period of relatively high interest rates for some time.
Right. And the world economy is probably also slowing.
Yes.
According to one of the forecasts by Fitch, the world economy is expected to grow 1.4% in 2023, cutting the forecast from 1.7%. Now, we can quibble with the exact number, but the direction looks like it's slowing down. So do you think the world has overreacted or overextended, if you will, the high interest rate policy?
No, I mean, I think there are some underlying pressures for lower growth. I mean, if we start here in the region, in China, we have the impact of the COVID policy. We have also the slowdown that has been generated by the adjustment in the property market. In Europe, for example, the very high price of energy and the impact it has had on disposable income. So there are other factors that have been there. Now, certainly the need to tighten monetary policy comes at the time where GDP growth in countries countries is slowing down. The real question is when it is more opportune to fight inflation. And I think that the consensus among central banks is that we need to tackle inflation relatively quickly and in an opportune way, because if we allow inflation to be rooted and to be ingrained in the minds of the people, it will be far more difficult to bring down inflation later, and probably it will require much tougher measures from the monetary point of view. So in the short term, yes, in the margin it might slow down the monetary policy reaction growth, but in the medium and long term it's much better to get rid of inflation at an early stage.
Right, so as to manage the expectations of inflation, in other words.
Absolutely, that's key to keep inflationary expectations well anchored.
Right. There's also increasing forecast that the United States economy is going to head into recession. Do you share that view?
Well, I have to say that a few months ago I probably was a little bit more concerned about the impact of higher interest rates on economic activity, but and other aspects again that have been affecting growth in the US. But I think the most recent figures on the job market, on economic activity in general have been better than expected. I think that the indicators that have been released recently on the performance of the U.S. economy has surprised on the upside. And so without being completely in the zone where we can declare victory, but so far so good. And there is a fair chance that the recession might be avoided.
Avoided?
Yeah, it might be. It is in the realm of the possibilities.
Right. Well, of course, some people say it could be a short recession.
Yes.
You think that it might go as far as being avoidable?
Well, it could be. It could be. I mean, I also don't discard.
Sure.
But so far, so good.
Well, since we are in Hong Kong, and we are in a situation where Hong Kong's monetary policy is, of course, tied to the U.S. Federal Reserve because of the currency peg. Next year is the 40th anniversary of the currency board system for Hong Kong. This day and age, does the currency peg, does it still serve Hong Kong?
Well, I don't see why not. I mean, certainly it has given Hong Kong monetary stability. Certainly the dynamism of Hong Kong and the region as a whole has preserved this economy in a very vibrant state, competitive, very competitive. You just come in and you see all the bust, all the energy, and so that means that things are happening in a positive way here in Hong Kong. And therefore, for sure, the exchange rate regime doesn't seem to be a factor that is inhibiting all that. I think it has served Hong Kong well. It has served Hong Kong well because it has allowed for monetary stability to be in place since its inception. So I think it has been a positive decision.